Today we're going to talk about how to analyze an investment. Before we get started, does anybody have any questions, any comments about the market? Clearly the market is in a bull market, as we said before. It's continuing to rise, regardless of the economic condition of the world. This again is because of the massive liquidity and the fact that the world banks, the Federal Reserve, and the banks around the world are basically saying they'll do anything it takes to get the economies going. So, with that in mind, I think that confidence. The assumption is with the liquidity, the capital coming into the market, coming into the economy, has brought a lot of money into the market, considering there's not much out there right now. Real estate's really off the books right now. It's creating prices to rise. We can see that some of these companies are actually all-time highs, like Amazon. Microsoft is charging up. Facebook reported earnings today. It's continuing to rise. Tesla reported today, eked out a little bit of earnings. It's trading over 800. So really, when you're looking at it, there's a huge disconnect between Wall Street and Main Street. The economy clearly is in shambles. Tomorrow they're reporting unemployment numbers again. It'll be terrible. The Federal Reserve today came out and said they're keeping interest rates at between 0 and 0.25. So although the economy is not in good shape, they're trying to open some places. That's probably not going to go too well. If the whole country's not open, that's going to be a danger to create more problems. But they'll try. Regardless, though, these companies, a lot of these companies are not going to make any money. Airlines are going up, banks are going up. All these companies, these publicly traded companies are all going to struggle for the next several quarters. Airlines are talking maybe 2 to 5 years to come back to where they are. All that being said, it doesn't matter. At the end of the day, it's money flow, right? It's the flow of money, and as long as there's flow of money, then the market's going to go up. Doesn't matter what's going on. So they'll drive the prices. It appears, they're going to follow suit. The prices are going to go up to the point where none of these companies are going to produce any sort of return. And at that point, that'll be the risk point, I think, where we could revisit, the lows, the recent lows, and we could see the market go down again and dip again. We'll see. At some point, the banks, can't fix that problem. They can't fix the economy directly. They try to, make sure that the credit's available and there's lots of money flowing around and there's liquidity. But ultimately, they can't reverse what's happened or, make companies hire people that they don't need. At some point, that game can't be played. So we'll have to see what happens. But again, as I said before in the previous weeks, I assume the market's going to come right back to where it was, which it's not too far away from where it was, all-time highs, and that'll be again a point where we'll have to see what happens. Other than that, the opportunity to learn and better understand, what to do with, if you have an RSP or 401k or whatever it is you're working on, what to do with it, how to manage that, what opportunities are available, comes down to education, always education, and learning how to do, learning how to best utilize the opportunities that are available in the market now. So if you remember, the things that I said in the previous calls was the market. Well, before I do that, actually, apologies, I want to let everybody know that one of our trainers in the U.S. actually is holding a free training for all Legacy students. You're all welcome to come. I'm going to give you the details. If you're interested in going, it's on Zoom. She will be doing the class on Saturday. I don't know exactly. Let's see here. So it says students can email her to join the Zoom meeting on Saturday. She has instructed momentum and marketing training. Most discussion will be around marketing your real estate business and answering your real estate questions. This is not a legacy training. There is no cost. You're all welcome, okay? So I'm going to actually post that information once now, once at the end. So let me get that first. And if you are interested in joining that, there's no cost to you at all. This is just a bonus that one of our trainers wants to do because she knows that people are not doing much. She's American. We don't have to hold that against her. She's accomplished investor, and she's going to talk about how to market your business. So give me 1 second. How many of you would be interested in going to that class? Okay, good. I'm going to ask a few of you to actually post that to groups, any groups that you're in, to allow people to get in. Let me get the information for you. But it's very kind for her to do that. That's not something that she's required to do. She's not being paid to do that. She just wants to do it for the students because she, that's the kind of people we have at our organization that really care about the students and want to make sure that the students are still moving forward and making things happen. So give me a second. Let me get that, excuse me, for you. You know how you keep changing your password because you forget because it keeps logging you in. Yeah, I just forgot my password for my email. How's that? Well, that's stupid. Okay, give me 1 second. Okay, we did all this. Sorry, folks. Just when you need it, eh? That is the way it goes. Okay, let's just do this. Really? Hmm. We're almost there, kids. Give me 1 second. All right, we got it. There you go. So you can copy that email. Just email her and let her know that you would like to go, okay? She's going to work out the details. So everybody got that? Good stuff. All right. So any questions about the market or anything else, actually, before we get started? Okay. How many of you are investing right now? Who's investing in the stock market right now? Okay, Henry is, okay. Steve, okay, good. Okay, no, Steve, okay. You, Scary, what do you think of Tesla? Yes, a little bit. Okay. So I think that we talked about this. Okay. I think that the first thing you want to know about the market, is it bull or is it bear? Okay, we all remember what that means, right? So bull means the market sentiment is up, it's going up. Bear means down. Okay, so that's the first thing you want to identify about the market before you even identify the stock. Identify if it's a bullish market or a bearish market. So is it a bullish market or a bearish market right now? How do we know it's bullish or bearish? Okay, it is a bullish market. How do we know? Well, we know because the market obviously is in an uptrend more recently. The other thing we know is that bad news is not so bad and good news is great. The market does not, absorb or take in any negativity, it appears. A good example is the last 4 weeks, the unemployment numbers have been horrible, and each day the market has accelerated up. So that's one of the indications that the market is in a bull position. Also, stocks that we know are not going to make any money this quarter or next quarter are still going up. So it's indiscriminate buying is what's happening. Today, I think they said they almost had a 10-to-1 companies going up versus down. So 10 companies are going up for every one down. So definitely the feeling is bullish. Now, this is the key here. This is very important. You have to be dispassionate about the market in that when you're investing in the stock market, you can't worry about, your own biases to what's going on. So clearly the economies around the world are in shambles. There's no question of that. But that doesn't matter. That doesn't factor into the stock market the way you would think, right? So you could sit there in the last few weeks and few months, even a month ago and say, well, the market's got to go down because the economy is bad and these companies are not going to make money. Doesn't matter. The key factor in bullish and bearish comes down to very simply this, okay? Is the money going in or is the money going out? So when money's going in, so when the money's going in, so the money's going into the market, so that's in, market goes up. When the money's going out of the market, okay, it's going out, the market's going to go down. That's all there is to it. There's no question about it, okay? So if there's a lack of money, goes, or a lack of access to money, the market's going to go down. If there's an influx of money, the market's going to go up. What's happened in the last few weeks, several weeks? the Federal Reserve and the banks around the world have basically said we're going to continue to flow money into the credit markets, to the stock market actually, indirectly, and some directly. Like the Federal Reserve said they would buy ETFs, they would buy, junk bonds. The only thing they haven't said they would do yet is to buy stock directly, which Japan has done, and that did not work out for Japan. They own a lot of the stock market in Japan. The Nikkei is owned by the actual BOJ, Bank of Japan. So the country, is heavily invested in their stock market, and it really doesn't. There's a point where it just won't rise anymore. There's no opportunity. There's no opportunity to make any money because these investments produce such a small yield, a small return. So, is that the future of the United States? I think so. Most countries are going to run into a deflationary state. We're not quite there yet for those countries, but this kind of situation accelerates it as they get more involved. So they're artificially, producing a rise in the market. So how are they doing that? Money. There's a huge, amount of money flowing in, close to 50% of the GDP in the U.S. I don't know exactly how much Canada has put in or what the reflects of the GDP, but it's that increase of money flow without actual producing anything is going to create a rise in the market. So we're in a bullish market. So the next thing you do is you say, okay, I'm in a bullish market, so I should be leaning towards buying versus selling, or taking advantage of strategies that are strategies taking that profit on a rise versus a fall. Okay, so in the scenario where you have bull and bear, you can a couple things you can do is you can say, okay, I want to stay as balanced as I can. So what I'm going to do is I'm going to do 70% of my trade, my positions are going to be bullish, and 30% are going to be bearish, because I know that it's a bull market. Because even in a bull market, stocks can go down. Like, they can go down, right? But you have to recognize the current of the market. Going against that current would be risky. So you want to take advantage of the recognition it's a bull market. I want to lean towards bull strategies, taking advantage of. So an example of a bull strategy would be obviously buying a stock, which I'm not a fan of. Buying a call option, which is okay, better, or even buying a covered call or a spread trade. Those are all bullish. You can take advantage of a bull market. And the bear obviously would be the opposite. I'd be shorting a stock or buying a put, or doing a spread trade to the downside. So there's lots of opportunities and different ways you can approach it, but you need to identify first, is it bullish or is it bearish? Okay, is it bullish or bearish? I think that's the most important thing. So when we look at Tesla, which is the original question, first question you got to ask is, okay, is it a bull market? It is. Is Tesla bullish right now? There's no question Tesla is bullish. No question. Could Tesla continue to rise? Well, yeah, I don't see a reason why it wouldn't continue to rise. Could it, I think its all-time high is 960 something. Could it break $1,000? Sure, why not? Why couldn't it? I mean, I'm not telling you to buy Tesla, anybody. I'm not telling you to invest your money in there. I'd rather you all use paper money until you get a better understanding of it. But I'm just telling you the process of looking at a particular stock and saying, what am I looking at? First, I'm looking at, is the market bullish or bearish? And then I'm looking for stocks that are bullish or bearish based on the market. So the market right now is bullish. Is Tesla in a bull position? Yes, it is. Like I said, just reported earnings and it went up $100 today. It's unbelievable. So you can't even though Tesla's barely makes any money, just reported a quarter of earnings, which is a big deal for them actually, because they've been losing money since the beginning. Not a lot of money though, not a lot of return. Fuel or gas is cheaper than it's been in forever. I don't know how that's going to affect people buying those types of vehicles. They don't do a ton of vehicles. They're not nowhere near a Ford or a GM. In the production of vehicles or the sales of vehicles. So a lot of this value they put in Tesla, I couldn't even tell you where it comes from. I don't understand at all the mechanics behind the pricing of Tesla. So, but at the same time, I don't understand the mechanics of why someone would long term own um, Netflix or Amazon. These companies to me are, they're just fundamentally they're just not worth the risk in my view as a long term owner because they just don't pay enough in dividends to take the risk. And at some point you got to ask yourself, I mean, why, what's it worth? What kind of money do I have to put up to make this dividend that they're giving me? So, an Amazon, is I think it's 1,400. It's over 2,400. It's over 2,400 a share. Let's look at that for sure. I think it's higher, just higher than that. Let's see. So it is. Let's see. It is $2,418 today. It went up $100 also. Amazon pays 100 times price to earnings is 100 times. So that means you're basically getting $23 or $24 for investment of $2,400 is what it's saying. I don't understand why anyone would invest in a company that produces a 1% return. I don't, long term. So obviously it looks good if you bought Amazon at 1,800 and it goes up to 24. Well, that's great. Went up $600. Your paper profits look great. We call them paper profits because until you sell, it's not real money. But at the end of the day, if you're buying for price because you want the price to rise, you have to sell it to realize that. If you're buying for earnings, though, in the fundamentals, it doesn't make a lot of sense to me. So, myself, I invest for the buying and selling of stocks. I'm not looking for dividends. I'm not looking for returns. If for whatever reason there's a dividend opportunity that comes with it, great. But for the most part, I'm not looking to hold any of these investments long term. They're just, in my view, it's not worth the risk. Okay, so back to your question of Tesla. What do I think about Tesla? I think that we're in a bull market, and I think Tesla is bullish. That's what I would tell you. Okay, does that make sense? Is that fair? Good. Couldn't tell you how high it's going to go. Couldn't tell you if it's going to stop going up. There's a point where Henry might reverse, but the undercurrent and the current that rises, all as the current or the tide rises, it lifts all ships. So fighting against the bullishness of the market, I think, is a mistake. So I would not bet against Tesla, but personally I wouldn't bet for it. But if I had to, I would definitely bet for it, right? Because it's a bullish market and it's showing that it's got no problem continuing to rise. Okay, all right. Any other questions? What property would be good to start? We were thinking of a single family. What would be your advice? You mean to invest in? Right now, I would say, yeah, right now I'd say, run the numbers on every property, obviously, but I'd say that the safest thing you can do right now is wholesale. Wholesale is, buying a property and renting it out, I think is going to be a challenge. Buying a property and flipping it, I think is going to be a challenge because of the way there's too many unknowns, I think, for real estate right now. Way too many unknowns. So I'd be very apprehensive. I'd be very careful, and I would stick to wholesale because if you do it right, you're not trapped in the property. Not saying there's not opportunity or things you can do. I'm not saying that. There's a lot of unknowns. There's a lot of unknowns. You might buy a place to rent it out and find out the renters can't pay rent. Who knows what's going to happen with this situation or how long it's going to take. Would you invest in the U.S. now or wait? I would on real estate. I would just be looking for wholesale or perfect opportunities. The U.S. is a great market. There's great opportunity, but I mean, those opportunities, in my view, are going to become more clear and even better in the coming months. I just think it's high risk to try to do real estate like we did 5 months ago or 4 months ago. Would you recommend to create a business account to do trading instead of using personal account? At some point, you might decide to do that, Henry. I wouldn't worry about that now. I wouldn't worry about it right now. When you're getting into I'm going to trade and it's going to be my primary income. Yep, I think that's something you want to definitely do. Right now, I wouldn't worry about anybody creating a company. Yes, you can create corporations, same kind of style as real estate. But right now, I wouldn't worry about any of that stuff. Yeah, I'd worry about first you gotta learn how to trade. Then you gotta show that you're disciplined by producing profits with a small account, and then you keep adding and growing and growing. But the problem isn't, in my view, the problem isn't the size of the account. The problem isn't even are you in a corporation or is it personal right now. The big question is, can you make money in the stock market? Do you know how to make money in the stock market? And that typically comes down to discipline, more than anything, I believe. So there's a lot of good systems and approaches to investing in the stock market. Most of those break down because they're mismanaged, right? People don't manage the account or they don't follow the rules. That's typically what happens, right? You get emotional, you start demanding things from the market, thinking the market owes you something. That the emotion is what messes things up. We're not born traders. I don't believe that at all. I think that our intuition actually is very difficult. Intuitively, the market to us doesn't make a lot of sense. The way it moves doesn't make sense to us. It's not something that is easy in any form. I believe stock market's not easy to apply a system to. The systems themselves, you can learn, you can understand them. They're not complicated, but the application of it is a challenge for most people. That's why, a small percentage of people make money in the stock market. Most people lose money in the stock market. And again, it's like anything else. You can't expect to make money doing nothing, or nothing special. So if you want to become a trader, if that's your desire, you have to commit to it for real. This is making money for your nothing, really. You're not producing anything, you're not creating anything, you're not providing a service, and you're making money. So it's pretty special to be able to make money in the stock market. It's not something that the average person can jump into and just start making money long term. You can get lucky for a little while, but the market will take it away. It's really designed where a small percentage of people who really get it, and when I say get it, I mean get that they need to follow the rules and follow the system, will make money on it. And the amount of money you'll make, it's unlimited, what you can do in the stock market. So lots of advantages in the stock market. Obviously in real estate too, lots of advantages in real estate. They're different different advantages. So what we're going to do is we got about 30 minutes left. I want to get into, fundamentals versus technical analysis. That's okay. Does anybody have any other questions? Okay, so let's do this. Let's talk about that. Okay, so let's go to my screen. Everybody see that? Okay. Everybody can see that okay? Okay, good. All right, so there's fundamental analysis, which is the study of a company. That's one approach. And then there's technical analysis, study of price action, truth in the market, we call it. So fundamental analysis is different than technical analysis. I'll explain the differences. But really, fundamental analysis, really you're studying the company. So it tells us if the price is fair, to pay in regards of earnings. Okay, so most common, one of the most common methods used or indicators is price to earnings. So what does price to earnings mean? So we sort of talked about that, and I'm just going to go back to the whiteboard. Price to earnings is, we talked about this a little bit about Amazon. So we'll do something here. Okay, so price to earnings. Try that again. Okay, so price to earnings, we call it PE ratio, PE, right? P stands for price, price, and E stands for earnings, okay? Okay, so earnings. So what does that mean? Okay, so what it is if the price is $100 and I make $1, the price to earnings would be, what would be the PE ratio? Price to earnings would be 100. Okay, so I gotta pay $100 for every dollar that I make. That's the way you can think about it. It's pretty simple. Price to earnings. Okay, so let's take some examples. Okay, that's what price to earnings is. Okay, so let's do that in black because that was pretty yellow. So let's look at a company. Give me a company you want me to look at. So give me a company and we'll do the price to earnings on the company. Okay. Tesla. Okay, so let's look at Tesla. Okay, so Tesla, here's your price to earnings. Okay, so let me give it to you. So your P ratio, you ready? So your price to earnings ratio for Tesla, you ready? Is negative, what is it here exactly? Negative 153.52. What does that mean, folks? So 153.52. Yeah, means every share loses money. Every share loses money. Okay, they're not the only ones. There's other companies like an Uber, or there's other companies out there that don't make money. T-Doc doesn't make money. Um, uh, what's the other one? Zoom doesn't make any money. These companies don't make money. Zoom is, Zoom, I'm sorry. Zoom is price to earnings. For Zoom, if you want to know what Zoom's price to earnings are, you ready? So the P ratio, P for Zoom, I just put Zoom, okay? Zoom is, you ready? It is 1,876.21. Okay? So you have to pay 1,876 times for their earnings. To get what they pay, you got to pay what they pay, which is 8 cents. So you got to pay 1,876 times that to get the share price. Okay? So the earnings in this one is negative. So then for not for Zoom, it's not negative for Zoom now. Apparently it's 8 cents now. So for $146 investment, you make 8 cents a year. Earnings per shares are 8 cents, and so to me again, this stuff doesn't make a lot of sense. So let's look at a more a different example of something that we could do some simple math with. So let's look at Apple. Okay, so Apple. Okay, Apple has a PE of 22. Okay, which means you take the earnings and you multiply it 22 times. That's the stock price. Okay, so price to earnings. So the earnings are 1266. So earnings are 1266. $12.66 is the earnings. So if I multiply this by this, I'll get the stock price, which will equal somewhere around sitting at 292.30 right now. Does that make sense? So the earnings are $22. Earnings are $12.66. I have to multiply it by 22 times to get the stock price. Okay, that's not going to be exact because this is the market. You know, there's after market trading and stuff like that, and earnings change. You know, the exact earnings. So the estimated earnings per share is 1266. Price to earnings means I have to multiply. How many times do I have to multiply to get that $12? How many times do I have to pay to get that $12? Well, I got to pay 22 times earnings. So what does this all tell us? You know, at the end of the day, I want to know ROI. That's really what I want to know. What's the return on investment? So, you know, the return on investment is pretty simple. If I divide, income by investment, that'll give me the return on investment. So let's do that together. So if I calculate, I make $12.66. I divide that by $292.30. My return on investment is, anybody? 4.4%. 4.4%. Okay, does that make sense? So is everybody with me? Who's lost right now? Well, I took income divided. So everybody, just a reminder, ROI equals income divided by investment. That gives me ROI, yes? So income from Apple was $12 and, was it 66 cents? $12.66. Yeah, so $12.66. Okay, so that's your income, right? And your investment is how much did we say? $192.30. $192.30. Okay, so sorry, $292.30. $292.30. Okay, so if I invest $292.30, I make $12.66. My ROI would be income divided by investment. Income divided by investment. That gives me a 4.4% return. Okay? Does that make sense? Okay. That is price to earnings. Now, if you're a cash investor, you're getting 4.4%. You just invest cash, you get a 4.4%. That's it. That's the return. And I'll tell you that, that's not too bad for Apple. Apple usually produces, even less than that, So these companies like these companies everybody wants to invest in, because so many people want to invest in them, they produce a less and less return on investment. The stock price goes up, but you're investing more and more and more to make the same or relatively the same amount of money. So, if this price goes up to $500, you might feel good because the price has gone up. That's great, but your earnings are not going to go up. It's not going to double. So your price to earnings is actually relative to what you're investing will go down. Okay. So and again, I'm not telling you not to invest in Apple, right? I'm just saying that the returns on these are pretty slim, pretty slim. Good companies give sort of a crappy return on investment. What determines the earnings then, if not the price going up? I don't know what you mean. If the price, it does matter. If the price goes up, your earnings per share are going to go down. If this company, so let's just do a simple example. So if ABC company is trading at $100 and their earnings equal, $5, okay, per share, per year, right? What's their ROI? Their ROI is how much? 5%. Everybody see that? Okay, pretty simple, yes? Okay, if ABC goes up to $200, because everybody likes that, they think it's a great company, their earnings are not going to double. Okay, that's just the price value going up. So, excuse me. Let's say the earnings stay the same. It's $5. What is your ROI now? 2.5%. You see that? Now, the idea is if you invest these companies, they're going to use the money to expand and grow and stuff like that, which they do. But they're not going to double when the stock price doubles or triples. It's not going to happen. So as the stock goes up, often your price to earnings, it's going to look worse. You're going to have to pay more and more and more to get the same amount of money or close to, or maybe a little bit more, but not enough to cover the increase. So your percentage of return goes down, yes. What affects the earnings? Well, that's everything the company does. Everything the company does. So the company has two mandates, more than two, but just example, they want the price to go up, the stock price to go up, and they want to produce earnings to their investors. Now, big part of the reason they want to invest, earnings for their investors, they want their stock price to go up. So if you're paying earnings to someone investing in your company, which is, in my view, a good thing, a fair transaction, as long as it's decent, the company will continue to produce earnings, and it's a good, viable company. It makes sense. The stock price will go up. The problem is the higher and the higher it goes, the less the return is, right? And Amazon's guilty of that. Amazon is producing 1%. It's a 1% return. Investing for 1% return, in my view, does not make a lot of sense. So what is a good return? We talked about this. A good return on investment, I think, is double digits is good. So for ROI, it'd be great to see a 10 ROI, 10% return. How do you get that in the stock market? Pretty tough. Pretty tough to get that in the stock market. Really tough. So to give you an idea, a PE ratio of 10 would be a 10% return. Because I got to pay 10 times what I make in earnings. Okay? So if a stock was $100, they pay me $10. You're not going to find that in most healthy companies as a return. You're just not going to find that. Could you manufacture or create a 10% return? You could, if as an example, if ABC company, produces is $100 and its earnings is $5, their ROI is 5%. But because I'll show you how to do this later. Don't worry about it right now. I could use leverage from my broker to only have to put up, instead of $100 because of leverage. Okay, so we're gonna call that margin. So margin often is in the 50% range. which means, what does that mean? I only have to put up $50 per share for ABC stock, but I'm still getting the $5. So that turns my 5% return into what? My 5% return turns into 10% return. Does everybody see that? That makes sense? So, and this is the thing, it's tough to get even a 5% return. You know, it's tough. Even a 5% return is pretty tough. So, you know, it's not even a 5% return in the market is difficult as a return. So to give you an example, Facebook PE ratio is 30. So Facebook's PE ratio, Facebook, good company, right? PE, price to earnings, is 30. What does that mean? It means what does that mean? It means for every, what does it mean? If it's 30 times, it means for every dollar, what do I got to pay? 30 times. 30 times. I got to pay 30 times for every dollar. Okay? So if I want to make $1, I got to pay 30 times that to make that money. So an example would be their earnings, their E is $6 and says 9 cents. So I multiply that 30 times, that'll give me the stock price. Okay? That'll give me the stock price. So today, because they reported earnings, their stock is higher than this. But you know, what's 30 times 6? Yeah, exactly, 180 bucks. Okay? But right now they're trading at 214 because they reported earnings and it was good, and aftermarket it went up again. Okay? So it's about 180. So what does that mean for ROI? Well, if I take 609 and I divide it by 180, what's their return? $3.4%. So their stock is even higher now. So that return is actually lower. So good companies, your return is going to suck. Okay? Your return is going to suck. Okay? So another way to work out price to earnings, just to give you an example, ABC stock has a PE of 25. What does that mean? It means for every dollar that I want to make, what do I have to pay? For every dollar that I make, what do I have to pay? I have to pay $25. So if I wanted to calculate the ROI just based on that, what do I got to do? I take $1 divided by $25. That'll give me my return on investment. So what's $1 divided by $25? $1 divided by $25 is 4%. Good. So using that principle here with Facebook, I don't need to know their earnings, their exact earnings. I don't even need to know the stock price. If I take $1 divided by 30, what will it give me? $1 divided by 30 equals 3.4%. Yeah, 3.33. I just rounded up. 3.33%. Same number as this number, okay? So price to earnings will give you your return on investment. Does that make sense to everybody? Okay. So here's your homework, because we're going to wrap up. Here's your homework. I want you to find 5 stocks. So let's do this. So we're going to find 5 stocks. This is your homework. So find 5 stocks. Okay, 5 stocks, and find out obviously the stock name, but their PE ratios. And I'd like you to find, if you can, I want you to find 5 stocks, and I want you to find 5 of them that are over 5% ROI. Okay, 5% ROI. Okay, so if it's a 5% ROI, what's the PE ratio need to be at least? What's the PE ratio need to be? $20 or lower. Or lower. Okay, so 5% would be 20. Anything lower than a 20, anything lower than a 20 will be better than 5%. So I'd like you to find 5 stocks. The higher the better. 5 stocks, find 5 stocks with a 5% higher, and do some research and see if you can find ones that are actually with a P ratio of 10. P ratio of 10. See if you can find some with P ratio of 10. So 20 or higher is what we're looking at. Okay? Any questions before we wrap up? Okay, good. All right. No, good. Okay. All right. Does everybody have that information about the training? No problem. That's the training info. Please post it to if anybody you know that if you're part of a group, let them know that it's available. To email Monica and she'll give you the information. Okay, so email Monica that I'd like to be a part of this training, and she'll give you the information. Okay. All right, everybody. If you're good, type in yes or Y. Good stuff. All right, folks, I'll see you all Monday at 8 o'clock for a little recap of the market. And otherwise, we'll see you all next Thursday. Next Wednesday, same time, 8 o'clock to 9 o'clock for our hour. If you need anything before then, you know how to reach me. I want you to have a good week. Stay safe and enjoy this time you have kind of doing your own thing. Take this opportunity to learn and another way to make money and spend time with family, for sure. Take this advantage. All right, folks, have a great week.